Welcome to the Deep Dive. Today we're tackling Upland Software's Q2 2025 earnings call. And you've brought us the details on what looks like a company really trying to turn a corner.
Yeah, definitely. It's quite the story. They're juggling this big strategic pivot, trying to become more focused while also dealing with, some significant financial maneuvering.
Right, like that debt refinancing we heard about.
Exactly. And all this against a backdrop where the market reaction seems, a bit unsure about the whole thing.
So our mission today is to cut through that uncertainty for you, figure out what's really going on with Upland, and get you fully briefed on the key takeaways.
It's about balancing those headline numbers against the longer-term strategy they're laying out. Lots to unpack.
Okay, let's jump right in then, the headlines. Upland reported Q2 revenue of $53.38 million.
Yeah, and that number, it actually nudged just past what analysts were expecting. So a slight beat on the top line.
Okay, sounds good so far. But what about the bottom line?
Well, that's where it gets a bit more mixed. But on GAAP EPS, that came in at $7.15. And that missed the consensus estimate.
Missed. Okay. And the GAAP number, just for context.
The GAAP EPS was a loss of $7.51. So, yeah, a bigger loss under the standard accounting rules.
But you mentioned there's more to the story than just revenue and EPS. What about the operational side?
Right, exactly. If you look at adjusted EBITDA, that hit $13.6 million.
And is that good?
It's pretty solid, yeah. That translates to a 25% margin. And importantly for you, that margin was up 500 basis points, 5 full percentage points compared to the same quarter last year.
Wow. Okay, 5 points is a significant jump. What about cash flow?
Free cash flow was positive at $2.7 million. Now, we should mention that number was dragged down a bit by some one-off costs.
One-off costs related to what?
About $7 million tied to those divestitures they've been doing, selling off parts of the business.
Got it. So underlying cash flow might be a bit stronger.
Potentially, yeah. And maybe the biggest sort of qualitative highlight management kept emphasizing was this return to positive core organic growth.
Core organic growth, meaning for the parts of the business they're actually keeping.
Precisely. They see that as a really critical turning point. And frankly, that's probably what they want you to focus on most.
Okay, so improved margins, positive core growth. But you mentioned the market reaction wasn't great.
Yeah, that's the head scratcher. Despite those operational positives, the stock, it closed down over 15% on the day they reported.
15%. Ouch. So management's painting one picture, the market's seeing something else entirely.
Exactly. And for you listening, the big question is, why the disconnect?
Yeah.
What are investors seeing or maybe not seeing?
Let's try and figure that out. That revenue number, even though it beat estimates, was still down year over year, right?
Yeah.
Significantly down.
Oh, yeah. Total revenue was down 23% compared to Q2 last year. That's a big, bold number that definitely catches your eye.
23%. Okay, so how does management explain that kind of drop, especially when they're talking about positive core growth?
Well, that decline, both for total revenue and the recurring subscription revenue, it's largely by design. It's a direct result of them actively selling off assets.
Selling off assets? Why?
They're pruning the portfolio.
Yeah.
Getting rid of businesses they see as lower margin or just not fitting into their new, more focused strategy. Think of it as strategic subtraction.
So they're deliberately shrinking the top line for now.
That seems to be the play. Management is really firm on this point. The growth rate of the retained core assets, or the stuff they're keeping, has turned positive. That's the milestone they care about. It's a clear shift away from their old roll-up model of just buying lots of different software companies.
Okay, so sacrificing near-term overall revenue for a potentially healthier, more profitable core business down the road, does that show up in the margins already? You mentioned the EBITDA margin was up.
Absolutely does. You hit the nail on the head. That jump from 20% adjusted EBITDA margin last year to 25% this quarter, that's a direct consequence of selling those lower margin units and also finding some operational efficiencies.
Like what kind of efficiencies?
Well, they mentioned terminating a legacy R&D outsourcing contract, for one, and they're leveraging their newer center of excellence in India. Things like that add up.
And they expect margins to keep improving.
Oh, yeah. The guidance is pretty strong there. For Q3, they're talking about margins potentially north of 30%. And for the full year, they're targeting around 27%.
30% plus. Wow.
Yeah, that would be up 700 basis points for the full year compared to last year. 7 percentage points. It really signals they're serious about profitability over just, size. For you, that's a key indicator of this strategy shift.
So restructuring, margin focus. But what's the new Upland going to be about? Management's talking a lot about AI, right?
They are. That seems to be the core of the new strategy. They're repositioning the whole company around AI-powered knowledge and content management.
Okay, sounds impressive. But what does that actually mean in terms of products?
It means they're pouring investment into enhancing key products with AI capabilities, like integrating Panviva with Microsoft Copilot Studio.
Okay, that makes sense. Linking into the Microsoft ecosystem.
Right, and getting their RightAnswers product onto the AWS Marketplace, making it easier for cloud customers to find and use. Plus, using tools like BA Insight for connecting enterprise data, which is crucial for large AI projects.
And helping with RFPs too, I think.
Yeah, Qvidian now has AI assist features for automating requests for proposal responses. They also mentioned something called headless knowledge management.
Headless.
Yeah, basically meaning the content or knowledge is managed separately from how it's displayed or used. This makes it super flexible for different AI applications to tap into.
So they see AI as a genuine growth driver, not just hype.
Management explicitly called it a tailwind. They think it opens doors for bigger enterprise deals and creates opportunities to sell more to existing customers.
Has this focus gotten them any recognition yet?
It seems so. They highlighted getting 68 badges in the G2 Summer 2025 reports, which is pretty good visibility. And they were included in a Gartner Market Guide for customer service knowledge management systems.
Okay, so the industry is starting to notice the shift.
Yeah, the challenge for them, and for you watching, is translating that recognition and AI capability into actual sustainable revenue growth for that core business.
Right. Now, all these changes, selling businesses, investing in AI that costs money and involves risk. You mentioned debt earlier. How's their balance sheet holding up through all this?
That's a really crucial piece, and there was some big news there, although it actually happened after Q2 ended.
Okay, what was it?
They completed a major debt refinancing. They secured a new $240 million 6-year term loan and also a $30 million revolving credit facility.
6 years. So that pushes out their debt maturity quite a bit.
Hugely. The new maturity date is July 2031. This basically removes that near-term worry about debt coming due, which could have really hampered these strategic moves.
That must be a relief for them.
Absolutely, gives them breathing room. They also used some cash to pay down an extra $18 million of principal, along with the refinancing.
So what's the total debt now and the leverage?
Total debt is down to $240 million. And they said net leverage is now around 3.9 times adjusted EBITDA.
Okay, 3.9 times, still some debt there, but maybe more manageable now.
Yeah, it strengthens their balance sheet, it improves liquidity, and lets management focus on executing the AI strategy instead of constantly worrying about the next debt payment. It's a really important step, a strong signal they've bought themselves time to make this transition work.
Okay, so strategy shifting, margins expanding, debt sorted. What does their outlook, their guidance, tell us about the next few quarters? Are these improvements expected to continue?
Let's look at Q3 first. They're guiding for revenue between $46.8 million and $52.8 million.
Which is still down year over year, right? Because of the divestitures.
Exactly. At the midpoint, that's about a 25% decline compared to last year's Q3, still reflecting those asset sales.
But what about profitability for Q3?
That's where the story changes. Adjusted EBITDA is projected between $14.5 million and $17.5 million. And the margin, a very robust 32% at the midpoint.
32%? That's a massive jump from the 25% Q2 and way up year over year.
It is. An 1,100 basis point increase, 11 percentage points year over year for Q3. Really shows the impact of those divestitures and cost controls kicking in.
Okay, and the full year, what's the picture for 2025 overall?
For the full year, revenue is expected between $211.8 million and $223.8 million. Again, down about 21% at the midpoint due to selling off businesses.
But adjusted EBITDA?
Guided at $55.8 million to $61.8 million. That implies a full-year margin of around 27%, which, as we said, is up 700 basis points from last year.
So the pattern holds lower revenue overall, but significantly better profitability. What about cash flow for the full year?
They actually raised their full-year target for free cash flow. They're now expecting around $20 million.
Raised it. Why?
They cited a few things. Lower expenses related to the divestitures than maybe first thought. Getting some cash from selling interest rate swaps and lower cash taxes.
Okay, so $20 million in free cash flow. That sounds like a solid number they can use to maybe pay down more debt.
That seems to be the plan. Deleveraging is the priority for cash flow right now.
It really sounds like the financial engineering and the strategic changes are flowing through to the outlook, at least on the profit and cash side.
Yeah, the guidance paints a clear picture. Smaller company top line for now, but much healthier financially underneath.
What did they say about the general business environment? Is demand holding up for the stuff they're selling?
Management's take was demand environment seems fine, pretty straightforward. And they reiterated that AI is acting as a tailwind, helping pull deals through.
And how are they trying to capture that demand? Any changes to sales strategy?
They're definitely investing in demand generation. They mentioned rolling out intent data, figuring out who's actively looking for solutions like theirs to help their outbound sales teams, the SDRs.
Trying to be smarter about who they target.
Exactly. And hiring salespeople with specific domain expertise for their key areas. They also noted seeing more bookings coming from marketing efforts and a general focus on building the sales pipeline.
And M&A? Are they going to start buying companies again soon?
Not in the near term. They were quite clear about that. Right now, any extra cash is going straight to paying down debt. Deleveraging is job number one.
But maybe later.
They left the door open, suggesting it could be back on the table in maybe a year or so once this current transformation is more settled and the balance sheet is even stronger. So for you, the focus for now should be purely on their organic execution.
Okay, so we've got this story. Transformation, AI focus, better margins, debt handled. But then there's that big stock drop on earnings day. It just doesn't quite add up on the surface.
It really highlights that classic tension, doesn't it? Management is telling a story about strategic repositioning and future profitability. But the market, or at least a big chunk of it, seems fixated on that immediate headline revenue decline caused by the divestitures.
And the EPS miss probably didn't help either.
No, definitely not. The analysts likely focused on that too. So you have this neutral to cautious sentiment where investors are trying to weigh the good stuff, the margin expansion, the core growth turning positive, the successful refinancing against the shrinking top line, and the reported losses.
It's like the market is saying, okay, the strategy sounds nice, but show me the overall growth eventually.
Exactly. It's a classic show me story. Upland needs to prove that this leaner, more focused core can eventually re-accelerate growth, or at least be profitable enough to justify the transition. That standoff creates risk, but maybe also opportunity for you, the listener, trying to figure it out.
All right, so looking ahead, what are the key things you should be watching? What are the biggest risks that could derail this plan?
Okay, on the risk side, the most obvious one is if that headline revenue contraction continues for too long or deepens unexpectedly, it could just keep overshadowing any improvements in the core business in the eyes of investors.
Makes sense. What else?
Debt costs are still linked to interest rates, specifically SOFR. So if rates stay high or go higher, that's a continued cost pressure, even with the new loan structure.
The macro environment too, presumably.
Of course. Any significant economic slowdown could definitely impact demand for their software, like any business. And critically, the big one is execution risk.
Can they actually pull off this pivot to AI-powered knowledge management effectively?
Precisely. If they stumble on integrating AI, launching new features, or convincing customers of the value, the whole strategy could falter. That's probably the biggest internal risk.
Okay, those are the risks. What about potential positive catalysts you should look for in the next, say, 3 to 6 months?
Well, the Q3 earnings report will be huge. You want to see if they hit or beat that strong margin and EBITDA guidance they just set. That would build credibility.
Deliver on the promises.
Exactly. Also, watch for announcements of new enterprise AI features actually rolling out. Any signs of increased traction for their products on the AWS Marketplace would be positive.
What about the integration after selling off those businesses?
Yeah, just confirmation that things are running smoothly post-divestiture, that there aren't any lingering operational hiccups, and any updates showing further reduction in net leverage under the new credit facility would also be welcomed by investors.
So basically signs that the plan is working as intended.
Pretty much. A clear beat on margin and free cash flow in Q3, combined with evidence that core growth is at least stable, if not improving slightly, that could really start to build the case for the stock to be reevaluated.
All right, we've covered the results, the strategy, the risks, the potential catalysts. It feels like a good time for our This Is Not Financial Advice segment. Remember, this is purely for entertainment, to get you thinking.
Okay, let's have some fun with it.
Based on everything we've discussed about Upland Software, this deep transformation, the AI bet, the market skepticism, what's an outrageous but plausible trade idea.
All right, so you've got Upland, a company throwing out the old playbook, the roll-up model, and going all in on becoming a focused AI-driven player in knowledge and content management.
While cleaning up the balance sheet and boosting margin.
Exactly. They bought themselves runway with the refinancing. They're guiding for impressive profitability improvements. They say the core business is growing again. But the stock got hammered because the overall revenue is shrinking due to those deliberate divestitures.
Classic disconnect. So what's the outrageous play?
Our outrageous but plausible idea here is a contrarian AI turnaround play with a long-dated call option.
Okay, break that down. Contrarian, AI, turnaround. Long-dated calls.
Right. The contrarian part is betting against the market's current negativity, which is focused on that shrinking top line. The AI turnaround part is believing that management can actually execute this pivot successfully.
And the options part.
The idea is maybe you buy a small starter position in the stock now to capture some of that dip. But the real kicker is pairing it with long-dated, slightly out-of-the-money call options, say expiring 18, maybe even 24 months from now.
Why long-dated options?
Because this turnaround isn't going to happen overnight. You need to give the strategy time to play out and for the market to potentially recognize it. The options give you leveraged upside exposure if the stock does eventually re-rate higher once they prove out the strategy.
So you get more bang for your buck if you're right, but you need time.
Exactly. The outrageous element is making this bet when the headline numbers still look rough and the street is cautious. You're betting on a fundamental transformation in a company type to roll-up that the market often discounts, and you're betting they can become a recognized AI player.
And the plausible part, what makes it not completely crazy?
The plausibility rests entirely on execution. If they hit those margin targets, if they keep deleveraging, if the core AI-driven growth story gains traction, and if the market eventually shifts its focus from the past revenue shrinkage to the future profitability profile, then the stock could potentially be worth significantly more. You're essentially betting that perception catches up with the operational reality they're trying to create.
A leveraged bet on management delivering and the market eventually noticing, got it. And that wraps up our deep dive into Upland Software's Q2 2025 earnings. Quite a journey, from divestitures and debt management to a full-blown AI pivot.
Yeah, it really is a fascinating case study. A company making some bold, arguably necessary, but definitely difficult choices, banking on a leaner, smarter future focused on AI and profitability.
And for you, the key takeaway really is that divergence we kept mentioning. The gap between management's internal view focusing on core growth and margins and the market's initial reaction, seemingly fixated on the headline revenue decline.
Absolutely. It just underscores how important it is for you to look beyond the surface numbers, understand the underlying strategy, and decide if you believe in the narrative. This will definitely be one to keep an eye on over the next few quarters to see if they can bridge that perception gap.
Remember, everything we've discussed today is for informational purposes only. It is absolutely not financial advice. We always encourage you to do your own thorough research before making any decisions.
Definitely dig deeper yourself.
Thank you for joining us on the deep dive. We'll be back soon with our next analysis.